Welcome to True Statement Podcast, where we bring clarity to your money and momentum to your vision. I'm your host, Aliyah James. Whether you're optimizing your personal wealth, scaling a business, or trying to navigate the space in between, the experts at True Statement Accounting Services have you covered. We're breaking down complex tax, growth, and wealth strategies into actionable steps you can use today. Let's dive into today's episode. In the last couple of weeks, we discussed individual tax returns and Schedule C forms, which is for businesses that have independent contractors or single-member LLC holders. We'll dive into how they work, when an LLC should consider converting, what shareholders need to know, and why filing on time is absolutely critical. So let's talk about what is a C corporation. A C corporation, often called a C Corp, is a separate legal and tax entity. That means the corporation itself pays taxes on its profits. Then, if profits are distributed to shareholders, those individuals pay taxes again on their personal returns. This is what people refer to as double taxation. C Corps file Form 1120, which reports the corporation's income, deductions, credits, and tax liability. C Corps are ideal for businesses planning to scale aggressively, companies seeking investors, businesses wanting to retain earnings inside the corporation, and owners who prefer structured corporate governance. If you're thinking about converting your LLC into a C Corp, it's usually because you're preparing for growth, investment, or long-term expansion. So, what is an S corporation? An S corporation is also a corporation, but is taxed differently. Instead of the corporation paying taxes, the income passes through to the shareholders' personal tax returns. S Corps file Form 1120-S, and each shareholder receives a Schedule K-1, which reports their share of the business's income, losses, and deductions. S Corps are ideal for small to mid-sized businesses, owners wanting to reduce self-employment tax, businesses with predictable income, and companies with fewer shareholders. To elect S Corp status, you must file Form 2553 with the IRS. Now that we know what a C Corp or S Corp is, let's get into when should an LLC convert to a C Corp or an S Corp. LLCs are flexible, but there are times when converting makes sense. When to convert to an S Corp is usually when your business is generating consistent profit, you want to reduce self-employment taxes, you're ready to take a reasonable salary plus distributions, and you have fewer than 100 shareholders. When to convert to a C Corp? Well, this is different. Usually it's when you're seeking investors or venture capital, you want to issue stock, you plan to retain earnings inside the business, and you're preparing for large-scale growth. Converting your LLC isn't just a tax move, it's a strategic business decision. Remember, I mentioned shareholders, so let's get into understanding who they are. Shareholders play a major role in both C Corps and S Corps, but the rules differ. For C corporation shareholders, they can be individuals, other corporations, or foreign entities. C corporations can also have unlimited shareholders. They also have multiple classes of stock, whereas S corporation shareholders must be U.S. citizens or residents. They cannot be partners or corporations. There is a limit to 100 shareholders, and they can only have one class of stock. So for S corporation shareholders, each shareholder receives a K-1 form, which must be included in their personal tax return. All right, so now that we've discussed who shareholders are and the limitations between each corporation, let's discuss why filing on time matters. Corporate tax deadlines are very strict and penalties are expensive. C corporation deadlines are April 15th or the 15th day of the fourth month after year end, whereas S corporation deadlines are March 15th. Missing these deadlines triggers penalties. So who gets penalized? For C corporations, the corporation is penalized for late filing and is also penalized for late payment of taxes. Whereas S corporations, the corporation is penalized for late filing and shareholders are indirectly impacted because they cannot file personal returns without their K-1 forms. The IRS charges $220 per shareholder per month up to 12 months for the late filing. For example, this means if you have 5 shareholders, your penalty can reach $13,200 just for filing late. Timely filing protects both the business and the individuals involved. Choosing between a C Corp and an S Corp isn't just about taxes. It's about the future of your business. Whether you're an LLC considering conversion or a corporation preparing for tax season, understanding how these structures work helps you stay compliant, avoid penalties, and make informed decisions. If you're unsure what structure fits your business, True Statement Accounting Services is here to guide you every step of the way. Please visit our website at truestatementaccounting.com. And always remember, keep learning, keep preparing, and keep taking control of your financial future. Until next time.